So thanks for joining us. My name is Ariel Brukarz from Ocean Property. We have fielded a lot of questions recently from our clients relating to what is happening in Melbourne and specifically with rising interest rates and some of the uncertainty in the market. We've invited Sean White to discuss some of the current factors affecting the market and what he is seeing in the lending space. Sean was a chartered accountant with Ernst & Young at the start of his career, then moved into banking with ANZ for a 10-year period, focusing on large corporate and institutional loan markets. He's been running Harcade Advisory, now rebranded into Ziku Lending, for the last 7 years. So over to you, Sean, and you can give us a quick update on what is happening with the interest rate market and the loan market.
Great, thanks, Ariel. Appreciate the warm introduction. So to everyone, I'm Sean White. I'm the head of Ziku Lending's lending arm, and just going to go through today on a presentation about the current interest rate environment and some of the things that we're seeing happening and going forward, and where we think that's going to impact the property markets as well. So just a bit of an agenda. The first thing we're going to talk about a little bit is where are interest rates going at the moment, and where's the forecast, and what can people expect over the next 6 to 12 months. What's going to happen to property prices, and how are property prices going to be impacted by these interest rates? And also, as a third item, the key risks that I see and a number of people see on the horizon around the changing market at the moment. We'll also go into what to do in the current environment just to make sure that you're setting yourself up to deal with the higher interest rates. And then as a last point, we'll have a property market overview as well. As always, if there's any questions, there is a Q&A function as part of the webinar, so please feel free to ask any questions you might have. And just a disclaimer at the end, all of this is just general advice. It's not specific to your circumstances, so contact your accountant, your broker, or your property manager if you're looking to talk about something specific. So the first item that we're going to look at is where are interest rates going. So I think if we looked at the top level of where interest rates have been historically and where they are, I think this chart will give you a little bit of a view of what's been happening over the last 20 years. The cash rate, 18 to 20 months ago or 24 months ago was at an extremely low level. So it was at about 0.1. And if you can see on my cursor here, that's where we were sort of 12 to 24 months ago. Those are emergency level interest rates. They were there for the pandemic. They were also there from post GFC, but really they were lowered by the RBA to spur the economy to get lending up into the economy, and also to get GDP, and to also get us through some of the issues that we had in the pandemic. Historically, as you can see in the chart, there's never been interest rates that low, 18 to 24 months ago. If you look at historically where interest rates have been over the last sort of 5, 10, 15, 20 years, we had a very large run up in interest rates around 2008, and then had a big drop because of the GFC down to about the 3% mark. It took another, really large event, being the pandemic, to drop the interest rates again to 0.1%. Again, the historic level that we've seen has been very, very low. What we're now seeing is that there is an exceptionally large increase in inflation, and interest rates are going up because of that. So we've had 9 consecutive interest rate rises that has taken us up to about 3.35%. It's actually the steepest increase that we've seen over the last 20 to 25 years. And you can see that in the chart, it's gone almost vertical there. The reason for that is because of inflation. So inflation's at almost 7% plus, and extremely high compared to where the RBA wants it to be. And that is that 2 to 3% band level. Probably the last point on this slide is to look at, we're expecting another 3 to 4 interest rate rises by the end of 2023 to early 2024. If we looked at what's causing the interest rates to go up, it's actually a range of items in a whole range of industries that are having very high inflation. One of the key ones here is to look at the black and red lines, seeing where the headline and underlying inflation's at, and we're looking at about 7%. Where the RBA wants it to be is in these two bands here at the 2 to 3% level. So as you can see, inflation is still very, very high. And the main sectors that are causing inflation are housing, which everyone would have seen from the increase in construction costs. You're also seeing it in recreation and culture. So, restaurants having to feel, higher costs because of produce and passing that on to clients. But also seeing it in food and beverages, but also in transport because of high petrol costs. The war in Ukraine has also caused that. So what you're seeing is a huge range of inflation across nearly every sector being above the band. So if you think that the band has to be between 2 to 3%, there is only one area that is below that, and that's communication. Every other area within the economy is having inflation above 2 to 3%, and that is causing interest rates to rise at the fastest level we've probably seen over the last 25 years. If you look at where we think inflation is going, inflation looks to have probably peaked at about 8% in December 2022. So we think we're past the peak of inflation, but it is still quite high and very much above the band of that 2 to 3% level. If you look at where the forecasts are for where we think inflation is going to go over the next sort of 2 years, we are thinking that inflation will come back down to the band level by the end of 2024. Okay, but until we see the inflation start to stabilize, interest rates will continue to go up. We expect that interest rates will go up 3 to 4 times this year. And we hope, and we're predicting that inflation will then start to taper down probably by the end of 2024, down to that band level. And you can see that here on the chart. The interesting point is to understand where the markets are pricing the interest rates. At the moment, interest rates are above, inflation is above the band at 2 to 3%. We are expecting that inflation again will continue to go up, for the short period of time, but then look to come down by the end of 2024. The bond markets, which are the markets that price interest rates, have already priced in almost 3 to 4 rate rises. So if you look at the current cash rate of about 3.35, the expectation is that the cash rate will now move to about 4.1 to 4.35%. Okay, so that's got another 3 to 4 rate rises built in the next sort of 12 months. That is an expectation that we'll have to increase those interest rates to make sure that inflation continues to come down from that 8% peak that we saw in December 2022. What does that mean for home loan rates and investment home loan rates? At the moment, we've got home loan rates at about that 4.7 to 4.8 mark. With the new interest rate rises, the expectation is that you'll start to see interest rates have about a 5.6 to 5.8% starting rate within 12 months. And that's a P&I rate. If you're looking at interest only for a home, it's going to be about 20 basis points higher. That's for home loan rates. If you looked at investment home loan rates, which are for investment properties, they're likely to have about a 5.8 to 6.2 base level within 12 months. Now, if you look at that compared to 12 to 24 months ago, that's a very steep increase. 12 to 18 months ago, you would have seen probably 2% to 3% for investment home loan rates. Rates almost now, from now to 12 months, will be almost double from where they are 12 to 18 months ago. And that's going to put substantial stress onto investment portfolios as well. And you need to be very aware of looking at your cash flow and understanding how that's going to impact you going forward. Interest only will probably be another 20 basis points higher than that. So you're looking at interest only as a bare minimum being around 6 to 6.2 to 6.4% within 12 months' time for investment loans. If we looked at new lending, okay, in terms of what the lending market is doing at the moment, this chart gives you a really good understanding. Is as you can see, total lending has fallen pretty dramatically over the last sort of year. You had almost $34 billion in new lending sort of at the middle of last year. And now you're looking at almost 23 billion sort of at the end of 2022. So new lending in its current form has fallen by almost $7 to $8 billion over the last 6 months. And we're at $23 billion as at December 22. Out of that $23 billion in new lending, almost $19 billion of that is refinancing. So it's actually saying that there's not a huge amount of new lending for new purchases. A lot of the activity, almost 80 to 85%, is refinancing. And what we're finding, and I'm talking to a lot of clients about this, is that there is a huge amount of refinance activity to get your rate structure into a better position than what you're on at the moment. The data that doesn't probably show this is how many fixed rates investors and owner-occupiers have. At the moment, about 1 in 3 people has a fixed rate mortgage. The prediction is that by the end of this year, nearly all of those people will be on variable rates. And so they'll feel the full impact of the interest rates increasing on their entire portfolio. But as you can see, lending has dropped off and refinancing has spiked considerably. Most of that lending has been for owner-occupied and investment loans. As you can see, investor loans have also dropped over the last 6 months, and you're finding that first home buyers are being priced out of the market for the last 6 to 12 months, and they've also dropped as well. One of the key items that is impacting borrowing capacities at the moment is the bank's assessment levels. So a bank will not look at what the current interest rates are. They do put a buffer on top of the current interest rates to see if you can service loans above the current interest rates. As everyone can see here, 6 to 12, 18 months ago, the mortgage rate was about 2.4% and assessment rates were at an average about 5.4%. You're now seeing that interest rates are at an average of about 5.2 and assessment rates are about 8.23%. What you're finding is that has led to almost a 30% reduction in nearly everyone's borrowing capacity. So if you were able to borrow $1 million 18 months ago, you're probably going to be able to borrow only about 700,000 given these new assessment rates. Now, the prediction is that as interest rates increase, these assessment rates will continue to go up. So we're looking at 8.23 at sort of the February mark now. If interest rates were to go up another 1%, we're looking at almost 9.23% as a buffer level. So you'd expect borrowing capacities to also come down again in the next 6 to 12 months because of this. These are some of the rates that you'll see around the serviceability buffers for investors as well. Again, you're seeing that investment buffer rates are quite high, almost 9% now. with another 1%, you're looking at almost close to 10% as an assessment rate. That's going to impact both the owner-occupied and investor markets, because the borrowing capacity is going to drop on both of those levels by, you would think, by another 10% overall. So almost a 40% reduction in borrowing capacity from, say, 2 years ago to the end of this year. One of the key items that has probably kept the property market stable has been unemployment. So unemployment's at its lowest levels in almost 50 years. Nearly everyone that wants a job can get a job. The issue that we're facing here is, as interest rates go up, history does tell us that unemployment will go up. I think the forecast that the RBA is putting in is that an increase in unemployment by almost 1% in the next 12 months. Businesses will not want to invest as much because interest rates are high, and they will pull back on some of their investment. That'll cause unemployment to go up. That again will have an impact in terms of the property market. When people feel that there's an increase in unemployment, they're potentially less likely to buy. But again, it is still a very good unemployment number historically. Even though there will be a bit of a tick up, unemployment will still be expected to stay reasonably low, given the short labour supply and there's active job prospects in the market for most people. One of the items that is causing, I think, some angst around borrowers is wage growth level. So if you look at these charts, what you're finding is wage growth was actually very, very bad over the period of the last 20 years. There hasn't been a huge amount of wage growth. There's actually been a lot of deflation in wage growth relative to inflation. What we're starting to see now is that inflation, even though it is going up, it is causing wage increases to accelerate very, very fast. So what you're finding is most people in a job have found that their wages have gone up. Now, the issue is that because inflation is so high, that you're finding that the real impact of those wage increases is not as good as what it should be. So even though wages are going up by 3 or 4%, if inflation's at 7%, then your real wage growth is still negative. Okay, so wage growth is actually going up, but the inflation issue is still there, that living costs and all other costs are actually accelerating faster than wage growth. Again, that is a good sign that the market is finding that there is wage growth within the industry, and that's both in the public and the private sector. So you're finding that the private sector is increasing wages probably faster than the public sector. So if you have a government job, you're finding that you're still not getting those huge wage increases compared to the private sector. The private sector has private sector demand, and as an example, because there is a shortage of labour, you're finding that your wages are going up faster in the private sector versus the public sector. But in general, we're finding that wage growth will probably continue to go up because there is such a short labour supply in the market. That may change, especially into Victoria and a few other states, depending on migration levels. There is talk that migration levels will increase to help with the labour supply. So that may put wage growth under some pressure. But at the moment, we're seeing quite good wage growth. But the underlying story is inflation is still quite high. So the actual impact of that wage growth in real terms is negative for most people. So if your wage goes up by 4 or 5%, but your living costs go up by 7%, then technically you're worse off by 2%. So we really do have to get we really do have to get inflation under control before that wage growth can see some positive impacts. So what about property in terms of where do we see property prices going in the next sort of 12 months? Historically, as interest rates go up, property prices do tend to correct. So we've got that in the market, that over the last 12 to 24 months, we've seen interest rates go up by almost double, and we've seen a pullback in property prices of sort of anywhere from 10 to 15%. Another 1% increase in interest rates is likely to see property prices pull back by another 5%, with a view that they'll stabilise post the 2024 period. The other side of it is, as interest rates go up, you'll find that more borrowers, as they're coming off their fixed rate loans, will feel the pressure of those repayments go up. That is likely to put more properties on the market. And if the demand is not there, that may also assist property prices in going down for the sort of 5 to 10% mark. At the moment, there's very low supply in the market. There's not a huge amount of properties on the market. And that's actually keeping prices quite stable compared to where they were sort of 15 to 18 months ago. Interest rates, and this is probably the overall situation, is interest rates are forecast to decline sort of going into the early to mid 2025 period. So inflation they're expecting won't come under control until probably 2025, but the back end of 2024 is when we're expecting that interest rates will potentially go down. So you'll see a spur up in property prices as you see interest rates go down in that 2024 period at the end of it. Some of the key risks on the horizon, and I've been asked this a lot by clients as well, is where do we see interest rates going if we go above 3 to 4 rate rises? Now, inflation is just generally a very sticky thing. It's very difficult to get under control. There have been talks that the RBA may raise by 5 to 6 times to really squash inflation. This would take investment rates for home loans up to 6.5 to 7% as a baseline. That's likely to cause unemployment to rise and also risk of recession to also increase pretty dramatically at those levels. Do we expect that the RBA will be that aggressive? At this stage, no. We still think that it's going to be contained to the 3 to 4 rate rises this year, but people do have to be aware of what's going on and prepare themselves that if rates do go above that sort of 3 to 4 rate rises this year, that you have done your background work to make sure that you're comfortable with your situation. So one of the things that I'm sort of talking to most people on is a set of principles that you need to look at in the next 12 months. One is a cash flow forecast of your current income versus your expenses, just to see where you are for the next 12 months at those higher rates and factor in those higher rates. If you're unaware of what your repayments are, talk to your broker or lender. They'll be able to sort of forecast that out for you on what it looks like under these higher rate scenarios. Another thing to also look at is if you do get into cash flow distress, you must talk to your broker, your property manager, or your accountant. They will have strategies in place that they can talk to you about to help do that, potentially rent increases or going into interest only to help with repayments if you're on P&I. Also, what you don't want to do is not be planning for that, because if you do find that your repayments are substantially higher, you don't want to have to put your property on the market in an inopportune time because you're likely to not get the result that you want. So it's all about planning and talking to your professionals to make sure that there is some planning in place under these higher rates. So some other things for current investors to do in the environment at the moment is to, if you haven't talked to your broker, touch base with your broker. There are great rates and great deals out in the market at the moment for refinancing. Not only are they lower rates than you're probably on, if you've been with your existing bank for over 2 years, I suggest you're probably not on the best rate possible because they're not passing those rates through to you. So you need to talk to your broker, talk to your lender, and look at refinancing, or at least talking to your existing bank to get your interest rates down. If you are on P&I, and a lot of people may have moved to a P&I structure, think about interest only for a short period of time. That can be a 2 or 3 year period. You can move the loan to interest only, and you can probably cut your repayments down by 30 to 40%. Probably something to note there, moving to an interest-only loan is a full application process. The bank will look at everything that they would do for a full application. It's not as easy as it was 3 or 5 years ago where you could simply turn on the interest-only on a loan. Now the bank fully assesses you and make sure that you can repay the loan under that interest-only structure. Speak to your property manager if you're an investor. Talk to them about the rental. It's a very, very tight rental market at the moment. We do want to make sure that you're getting the right rent for the right property. And your property manager will be able to talk to you about that. And making sure that you're getting the best rent for the market, and that will subdue some of the cost increases that you're seeing on the interest rate side. Make sure you're maximizing the depreciation on your property. So you'll obviously have a huge amount of depreciation that some properties can have in your tax returns. That can lead to bigger refunds relative to the money that you're putting into the property if you've been negatively geared. So make sure you talk to your accountant around the depreciation. And if you haven't done a depreciation schedule, make sure you touch base with them and get it done. It's a very easy process, and you might find that you're able to claim 30% of that depreciation back in your tax returns to help out from a cash flow perspective. What to do in the current environment for buyers? At the moment, it does sound like interest rates are rising and there is some fear in the market. I think if you take the right position and look at it long term, it is potentially a great time to buy if you can sustain the interest rate increases, because interest rates will eventually go down, and you will have this ability to have been in the market when interest rates were high and coming into a market where you're going to get a property at a really good price. So it might be worth talking to your professionals now about seeing if you could get a pre-approval done, and also talking to your advisors about what it might look like if you purchase in the next 6 to 12 months. Discuss with your employer about a pay rise. Unemployment's at a very low level at the moment, and employers are doing a huge amount to keep good staff. And one of those things that they're doing is increasing people's wages. So have a chat with your employer, and that's a really easy way to negate some of the cash flow issues. If your employer is able to increase your wages above the inflation level, you would see that you'd have some benefit from talking to your employer about that. Another item for buyers is to cut back on discretionary spending if you're finding that your cash flow buffer is actually getting squeezed. So if you're finding that the interest rate increases and the repayments are squeezing your average cash flow, it might be worth talking to your accountant or advisor about your budget and making sure that you've cut out some other discretionary spending that you might not have to do. One of the other items is know your borrowing power. So at the moment, your borrowing power will change in 12 months' time. Have a chat to your broker or your lender about potentially, if you do have equity in your property, checking your borrowing power and getting that equity as a separate loan and keeping that potentially in an offset account where you can just keep those funds and borrow those funds now for a rainy day if you needed to, or for also potentially looking to buy as well for a deposit. Borrowing the equity and the money now is actually going to be a better proposition than looking at 12 months in time, because your assessment rates are going to be much higher at the bank level. So again, talk to your broker or lender about that borrowing power and how you might be able to access your equity now.
Okay.
Sorry, I'll just reset that. 1 second.
Perfect.
Okay, and that's sort of it from me, I think, in this stage. Open to questions and anything else that, wanted to go through.
We'll run through a little bit about what we're seeing in the property market here on our end, and I'll keep this relatively short. I understand people have other things to do than listen to me, but I will go through what we're seeing in terms of the property market. And what we've noticed, and I think the biggest thing to take out of all of this is that property prices obviously do go up and down. This is obviously in the last 10 years, what you'll notice here in the black being Melbourne, the red being regional. Property prices tend to go up a couple of percent, then they drop as, they topped out in 18, there was a decline back in 19, they go up, the pandemic hits, and obviously it was a short decline. You will have noticed that prices did go up substantially over the last couple of years. And as rates obviously reached their low in 2022, property prices started to come off as rates went up. And what we're seeing now is probably at the lower end of where we're anticipating the market. Obviously, as this chart shows, there will probably be a reverse in the not too distant future. Yes. In saying that, we have noticed the property prices are still on average about 13% higher than where they were in just before the pandemic. And I'll just get the presentation. So we're still seeing a 13% rise in property prices from March 2020, high and regional. Obviously, we did notice a lot of our clients head over to regional areas, Ballarat, Bendigo, and Geelong. Interestingly enough, we are seeing that come back. We also noticed as rates started to reduce, borrowing capacity went up. You'll notice here in the grey line, the search of $1 million to $2 million price points did substantially go up. And searches for properties between $500,000 and $1 million went down. As rates obviously go up, and as Sean mentioned, the borrowing capacity went down, we are seeing that flip. So the $500,000 to $1 million price point in searches, specifically on realestate.com, has started to uptick, and the higher price points have started to decline. So where we are going forward and where we see potentially property prices in the horizon. Firstly, the cost of construction saw a massive increase year on year. We haven't seen this increase in construction material and construction wages for probably about 40 years. And you'll see a massive spike up here in the last 12 or 18 months. What that means is it's becoming costlier and costlier to develop. That's going to have a direct impact on potential supply into the market. And what you'll see in the next slide is that commencements for constructions are starting to fall substantially. We're going to see that going forward. As interest rates go up, financing capabilities for developers will become more expensive. Their projects are not becoming feasible. And as construction costs go up, it definitely makes it less feasible. So what you'll notice here is we believe that construction commencements will continue to fall to probably levels that we might not have seen for 20 or 25 years. That will have an impact on supply, the supply side in the market. In terms of migration into Victoria, what you would have noticed here is migration started to uptick since 2010, sort of peaking around 2018 to 2019. Obviously, COVID hit, students left the market and workers left the market as well. And you would have seen a decline in population in Victoria in 2020. That has obviously upticked in 21 and 22. The forecast going forward is that we will continue to see approximately 80 to 100,000 net migration people coming into the state, which will be near on the peaks that we had before the pandemic. So what will that mean? As we're seeing now, rental prices are going up. So as migration comes back into Victoria, the inquiry levels have had a massive uptick, almost 60% year on year higher than where they were a year ago. You'll notice that the black line is Melbourne, that's going up. Regional, interestingly enough, the inquiry levels have dropped. That is obviously Melbourne, you've got the student, the workers coming in the market, and we do believe that the people that left Melbourne during COVID are now coming back into the market in Melbourne. In addition, rental listings are down significantly from where they were a year ago. So on one side, you've got massive demand, but the listings aren't there to take care of demand. What is happening is vacancy rates are at an all-time low. So obviously you'll see the peak during COVID around 2020. It's dropped down to an average of about 1.6%. So we are finding with the properties that we are putting on market, they're going very quickly, and we're having about 5 or 6 offers essentially per property. So there is definitely a massive increase in property prices. So you'll see that here. The black line is the average rental prices for houses. That sort of continued going up as there's less product in the market for houses. There was a dip in the red line, which talks about the units as COVID hit and people went out of Melbourne. That's now going back to pre-pandemic levels for rent. And we're going to continue seeing that rise for the next couple of years. So that 430 level is probably getting closer to reach to where the house prices are. So essentially, where do we see the market from here? I mean, the supply of rental stock remains constrained, and we aren't seeing more properties come to the market. So we are going to see that continue for the next couple of years. As rates go up and prices come down slightly, we're going to see rents rise. So what we're finding already is investors coming back to the market to purchase property. They're becoming very appealing investments. So even though the rates are going up, rents are going up to compensate for that. And as I said before, we are seeing the market being cyclical. We are probably now on the downturn, but going forward, we are likely to see an uptick in prices as net migration moves back into the market, and definitely developers slow down the amount of product that they're bringing onto the market. There will be a shortage of supply over the next 2 or 3 years, which we believe will have a positive impact on property prices. Right, so there were a couple of questions that we had from a couple of our clients. Sean, we had a question from Alex wanting to know if there are alternative sources of borrowing other than the 4 banks, and are they also currently lending?
Thanks, Ariel. Yes, there are a number of other banks and non-banks in the market. There's also a lot of tech startups that also provide home loans that are at rates that are probably at the bank or even lower. So, you don't technically just need to stay with the big 4 banks. There are a huge range of lenders that have come into the market very aggressively and lowered their rates and are looking for borrowers. So absolutely there is. And you should be talking to your broker about that widespread of lenders and who is actually offering you the best rates.
Yeah, and I think with that question, Sean, in terms of negotiating better rates, how do you, what's the best way of going about that in terms of trying to get a reduction? What do you see out there in the market?
Yeah, absolutely. It's a great question. So the first point of call you should do is talk to your existing bank. I'm finding that a huge amount of banks are pretty keen to reprice their clients' loans. They didn't used to be, but it's a very, very tight market at the moment. So the first point of call would be to either call the bank directly or your broker, and your broker can call on your behalf and ask them to reduce your rates. It's just generally a phone call or an email, but it might save you 50 or 60, sometimes up to 70 basis points on your loan just by asking the question.
Great. All right, we'll now wrap it up. If anyone else, we will share the slides and the video with all the participants as well. So that will come through to you shortly. And again, if you've got any questions, feel free to reach out to Sean. We'll share his details, or myself. My details are on the screen. And feel free to ask us any question either about the property market, about your rental or sale property, or obviously in terms of your current lending requirements. So again, thank you for your time, and we look forward to hosting you again for another session. Thank you, Sean.
Thanks, Ariel. Bye, guys.